Okay, so where we left off, we were just hypothesizing how to deal with this federal deduction of state if we are on the lag method. But since we're not on the lag method, I'm going to go back to treating myself as being on the current method of state tax. So, oh, couple, not many. California's the big one. We live in California. Okay. All right, so now I've taken my federal deduction for state taxes. I've pushed through my other federal effective state. You guys totally get it, and there's no more questions on that. And so we go down to our tax rate. So our tax rate is going to be 35%. Right, so here's another case where my formulas didn't work. It didn't carry a tax rate over to my deferreds. That makes no sense. So I'm going to change that. So that one's missing too. You're probably wondering how as a staff I ever survived if this thing didn't work, huh? Okay, so a good way to test it is, does it balance? It balances to 0, right? Flips to 0. Okay, so I'm looking good. So I have a federal R&D credit of 47.5. That's going to reduce my federal payable, and it's going to help my provision. So I've got my debit in payable, nothing in deferreds, credit provision. Okay. My total federal expense is 3187. My state expense is 818. It's just pulling from over here. My total provision is 4,000,005. Okay. You definitely do not need to write any of this down because I will send you the entire spreadsheet working very well. Okay. All right. So we're done. First tab done. Okay. The key here is every row balances. Every row makes sense individually. Okay. We good? Okay. So now, if we went to our deferred tab, so I'm going to go to the state deferred tab first. Okay, I'm going to blow that up a little bigger. So all this schedule does is it takes my deferreds, and you've seen me do this by hand a little bit in some of our earlier problems, but it takes my deferreds one by one, and it takes the balance that I had last year, it changes it for the activity I had this year, and it gets me to my ending balance. So I said this was the first year of my existence, so I had nothing at the beginning of the year for bad debts. I added back 45,000 of bad debts, and that's going to create a future deduction, so it's a debit. It's a future deductible difference. I multiply it by the state rate, and I get my state deferreds. Okay? Now the key is, you see this 21 right here that my mouse is on? That's a an increase in deferred tax liabilities for state tax deferreds, right? So that 21 ought to be the same 21 I just told you I had over on this schedule, right? Because this deferred column here, that should be what I'm telling you on my deferred roll forward is my change. It's the same information, right? So I'm telling you in this column, this is how I'd expect the deferreds to move. And if that's how they're going to move, when I go to the roll forward, I would expect them to move that way. Okay, so that 21, it's not a coincidence that that's the same thing. So all this schedule does is take my beginning of the year deferreds, take the change, which I just told you was that middle column in the payable schedule, and roll it forward to get to my end of the year. Okay? Everybody's provision out there has a deferred roll forward that looks something like this. This is automatic. Not everyone does their first tab the way I did it. In fact, I would call that probably unusual, but I think it's way clearer than a lot of other stuff I see. But everybody has a deferred roll forward that looks something like this. Can I scroll up a little bit?
You don't have anything in
So I'm looking at state first, not federal, in case I jumped over too quickly to that. We take one step back, yes.
Very simple. So when we have, on the state side, we have DTL 21803.
That's where we're at now.
When we went over to the Fed, do we treat that as DTA?
What do you think?
I think yes, based on our model.
Huh, nice. See, where I got my first guilty based on the model.
That's the part that gets me confused. There's a DTL for state.
Okay, so if we have a DTL for state, so this state tab we're looking at right now, it tells me in the future when this thing all kind of comes to an end, I'm going to have to pay $21,000 of state tax, right? So when I pay $21,000 of state tax, what do I do for federal? No, when I pay my $21,000 of state tax, what do I do on my federal tax return? You deduct it, right? So is deducting a good thing or a bad thing? A good thing, right? So all I'm doing on my federal tab, which you've kind of hopped ahead a step actually, even though you're trying to go back a step. On the federal tab, as I roll my deferreds forward, I have a deferred at the top here, which is a debit, which I think is what Janie was asking about.
Yeah.
That's me saying, oh, I have this other state tab over here, and it's telling me in the future I'm going to owe tax. So I know if I owe state tax, I'm going to save federal tax. And so this is just pulling, you can see from the formula, it's just pulling straight from the state deferred tab and saying, whatever I say I have for state deferred taxes, I'm going to have a federal offset. That's all it's doing. Did that answer your question with the abundance of clarity? Yeah. Okay, I know that's totally confusing, right? I totally get it. Okay, just try to think, what will happen in the future? What happens when I pay state tax now? What happens when I pay it in the future? It gets really confusing when you say I have a state DTA, but it creates a federal DTL, because that's weird to say that when I save state tax, I'm going to pay more federal tax. But it's always the inverse. Right? Whatever is going to happen in the future for state, the opposite will happen for federal. That's just how it works. Okay. Otherwise, this federal tab works exactly the same, right? You can see these numbers are the same. Okay, so I did my payable tab. That's where all the business happens, right? I get it balanced. I come up with my provision. The picture makes sense. My deferred tabs both just roll forward the temporary items and show them individually and show the activity to get from beginning to end. Okay, so now I'm going to go to a tab called Accounts. And this is where, if you've got a provision that's super screwed up and you can't figure out how to fix it, this is where to go. And when you do a provision, you ultimately have to book a journal entry, right? You have to call the accounting team and say, I would like to book a journal entry for my provision. And that journal entry has got a balance. And it's got to get you to an ending balance that makes sense to you, right? You can't just book a bunch of debits and credits and be like, I don't know, you know. You got to explain the ending balance. So what this tab is trying to do is it's saying, look, this is the first year of your existence. Okay, you have nothing. But now you started running your business and you got to book tax entries, right? So I told you what entries to book, right? It comes right off the bottom of this schedule. But you need to book them. So I'm going to credit my payable 3105, and you can see it's linking straight from the payable tab. And I'm going to book my deferreds, and that is also coming right from that second column in the payable tab. And then boom, out pops provision, right? And my total row foots to 0. So you can say, gosh, that is the journal entry I would like to book. And if you book your state provision, you do it the same way, right? You book with the amount that you've calculated you owe on your state tax return. You book the change in deferreds. Boom, you book the expense. Okay, and then a bunch of you were asking me about this payment thing. So I didn't show it in here, but if I was making payments, 3.6, if I was making a $3.6 million payment, I would debit my federal payable and credit cash. And if I was going to make state payments, I would debit my state payable, $390, and I would book a journal entry that looks like that. Grant?
I always get worried whenever I see a journal entry to cash.
You get worried when you see a journal entry to cash. Well,
Shouldn't it flow through an actual check cut?
absolutely. Absolutely. So in the real world, what happens is that entry is not something you should make up. It should be something that actually is already booked in the GL. And so this exercise of this account tab, this is you saying, boy, if I could start all over again, this is how I would book the entries. And then you'll normally compare that to what you've already booked in your GL to figure out how to fix it. So you might type in the schedule, boy, these are the payments I made, this is what I hoped I would have booked. The GL guys probably already booked it exactly the same. So there will be no difference based on what you do and what they do based on cash. And if there is, you have something really wrong. Right? But think of this schedule as if you could start from scratch and book all the journal entries you'd like, and you have total control. And then you're going to compare, well, what did the accounting guys already do? Okay? So think of this schedule as your schedule, not what the company already booked. Okay? All right.
So this isn't a proposed entry.
This is not the proposed entry unless we book nothing. Right. All right. So now we're done, right? We are done with year one. We have booked all our journal entries. Our ending balance looks like we overpaid our federal tax by $494. Looks like we underpaid our state tax by $406. And if like Jenny's your auditor and she's like, I'm coming to get you and I'm mean and you can't get anything past me, she's going to be like, well, prove that you're overpaid $494. Right? She's going to tell you to prove your ending balance. Right? You do any audits? Yeah, you, Jenny. Yeah, even when I quiz myself in my head with you guys, I mess you up, and I don't know why. You don't even really look alike. Your names are so similar. Jesse, do you ever do any audits? Yeah. What's that? All the time? Oh, of the tax. Forget it. Jessie will audit you, and she will come in and say, I see that you have an ending balance of $494,000, and she will want you to prove that's right. Okay? And you'll prove it's right a couple different ways, right? You'll say my journal entries roll forward, I get to the right answer, and I can explain all my individual journal entries. And I can also go to my payable tab and say, well, I think I'm going to owe 3.1, and I know I've paid 3.6, and so I can prove I'm overpaid, right? And so the key here is with this account tab is not only that every entry balances and it makes sense, but then you can explain the ending balance. Okay? You need to go along the bottom of this and say, do I know what these things are, right? My total deferreds of $103,000. If I went to my deferred tab, it tells me my deferreds are $103,000 after I take my federal and add my state. My total is $103,000. So if Jesse came in and said, okay, you were pretty good, you explained your payable, but there's no way you can explain your deferreds, like I can just tell you don't know what you're doing, then you would flip to this tab and say, no, I can actually explain my deferreds, right? It's everything in that column, one by one. But you as a sanity check, you ought to be thinking, well, what's at the bottom of my set of journal entries, because I need to explain those ending balances. Okay? Okay, we good with accounts? I didn't mean to flip off that fast.
Can we say the
Can you scroll down? Or scroll up?
Can I scroll down? This is just a journal entry.
Okay.
Yeah, don't worry about it. So this is what Grant was asking about, which is if you already had some balances, you know, what would you need to adjust them to? And this little thing would tell you how to adjust it. But right now we're starting with 0, so don't worry about it. Okay. You good? You looking forward to the take-home exam? I know I am. Okay, so when you looked at the, when you did the reading, hopefully, you saw what the required disclosures are, and when you read the Intuit 10K, you saw how they actually applied it. One of the disclosures is to put a table together of your current provision and your deferred provision, right? And this table does that for you. So you probably have the numbers memorized by now, because we're not dealing with a lot of numbers. State tax, our current provision is the number that came right off that third column, the 796. My deferred expense was that middle column, that 21. If I turn that into a journal entry, there was a deferred provision for the 21. So my total state provision is 818. Right? So when you read Intuit's 10K and you saw this table, you should think, oh, that's them telling me how much tax they're going to owe this year. And this is them telling me how much tax I'm going to owe or save in the future. And so that's their total provision for state in this example. And they do the same thing for federal, right? That's my federal, what I'm going to pay this year, my federal, what I'm going to pay or save next year, my federal total. So all that footnote disclosure is doing is it's pulling from other parts of the provision, right? It's very simple. It's all coming from the bottom of this payable tab. So the more you understand that payable tab, if this is the way you want to think about it, that is the key, right? Don't go 4 tabs down and try to figure it out. Figure it out in this tab first. Okay, then at the bottom of this page is a rate reconciliation. So I would expect my provision to be based off of PBT. That's 35% of PBT. I know my state provision is 818, and 65% of that, because I get a federal effect, is the 531. Right? And I have perms for meals and entertainment and penalties, and a perm for a credit. And then boom. There's a little formula in here that just takes the answer and plugs to some difference. And so if you put something in here wrong, it would just automatically force it back to be right. But if you do that on the exam, you do not get credit for that. Okay, so that's as a rate rec. And then the last tab just shows how your deferreds get broken out between current and non-current. But again, I don't care about that right now. That's not important to me. But for you to get to this tab and get this table working, and you get that top section to work, current and deferred, that's good. Okay? All right, that's the end of our year 1 provision in Excel. All right, so how are we feeling about that problem? It's pretty good. You guys, man. Okay, so we're going to blow through some materials, and then we're going to keep working on the problem, because the problem is about to get a lot harder. Okay? So step 7 was calculate the total provision. Step 8, reconcile the accounts. We just did this. Okay? So when I say the words reconcile the accounts, sometimes I know when I just say words, they just have no context for you if you've never done a provision, so it's useless. And so I kind of went through the problem with the accounts first, because now when I say the words, it might mean more. Okay? So you are not done with the provision until you understand what your account balances represent. Okay? And I'm telling you, one of the mistakes people make is they'll go do their current and they'll go do their deferred, but they'll never pull it all together in a journal entry schedule that shows how it balances. That is a huge mistake. I spent a handful of years ago, I remember I was working for one of the Valley's largest tech companies, and this was like right when Sarbanes-Oxley was coming out, and people were still pretty, kind of a lot of hacks doing provisions. And when I remember I was helping this company, and they had calculated their current provision. They did a calculation of what their tax return liability was, and then they had this giant deferred schedule, and then they had a rate rec, and they didn't have that account page. They had no idea how to book the entry. And so they asked me, they're like, well, how do we book it? And I'm like, what are you talking about, right? I mean, how do you book it? We go through an analysis of what all the journal entries we would book are, and then we compare it to what you've already booked in your GL, and that difference will be one adjusting entry. And when we did that, it didn't balance. So something was terribly wrong. And we spent, this was in January, because it was a calendar year company, it was year-end close, and the tax group was having like a nervous breakdown because they had no idea how to do that accounts tab. And I remember they shut off the heat in the building over the weekend because it was winter and it was freezing, and it was a weekend, and we just went around to all the cubes in the office and were stealing people's room heaters, and we just filled a conference room, and we were in there for like 48 straight hours trying to do that account tab. And it was like one of the top 10 Valley companies. So if you think like this is just for the basic stuff, I mean, most companies are far more sophisticated now, but even that basic debit credit account analysis, like I will never forget that career memory. And just like how stunned at the fact that people couldn't realize that the actual last step in the provision was to book it, right? So knowing that you have to book it, that is key, right? Don't just assume it all falls into place somehow, because it doesn't. And what we ultimately realized was their current and deferred and rate rec, they were all hard-coded and not talking to each other, nothing balanced. I mean, it was chaos, right? And so we ended up kind of doing the whole provision over again in like 48 hours, which is not fun for a big company. Okay. So I showed you a schedule like this, and you know, I want you to think in terms of accounts across the top and activity down the side, like you're going through a sequence of how every account gets from its beginning of year balance to the end, right? Tell the story of what happened to the accounts, but make sure every row balances, okay? That's key. It's pretty much the same. Okay, so I told you that Jesse was going to come get you and force you to prove out your provision or receivable. So when you get to the end of the year and you're doing your accounts, I want you to think, what's my ending balance? Could I prove it? And I have another career memory of that exact question where a company had about $100 million in their payable, and their global controller asked their director, I don't think we owe $100 million. And I remember the guy was like, that's probably right. And he's like, I don't think we owe anything. And I'm like, I don't either. Right. So there was soul searching there, for sure. That was character building right there. So when you do a proof, right, how are you going to do it, right? You're going to say, well, what do I expect? I'll go to my compliance person and say, well, what do you expect your payable to be, right? And you'll say, okay, well, I'm going to go to my tax return calc. I'm going to calc what I owe. I'm going to show what payments I made. I'm going to show what refunds I expect. I'm going to deal with amended returns or what the IRS says I owe. I'm going to add up all these things, and this is what I think I owe. And whatever I book to, ideally it's the same, right? So that this difference is immaterial, right? But auditors will ask you for this. They will say, prove your payable, and this is how you'll do it. You'll say, gosh, I can't just explain how I booked all these million journal entries, right? Because think of a big company, you know. When we talk to Yahoo, you can't just have them give you like a GL roll forward of all the things they booked. There's too many things, right? They will want you to prove your payable in a concise way like this. What do you owe the government? What do they owe you? Prove out your ending balance. Okay, rate reconciliations. So I think we've talked about this one plenty in class. And as we go through the materials in here, you should already know that in the rate reconciliation, you're going to expect to see perm items, credits, valuation allowances, foreign, right? If you have foreign income that's taxed at a low rate compared to the starting rate you assume your provision begins at, that's a big rate item, right? We'll talk about that in the last class when we cover international tax stuff. But I think we've done enough rate reconciliations now. You guys know to look for perms, things that permanently change the amount of tax expense or tax I'm going to pay or save, right? That's what goes in a rate rec. Hold on just one quick second. This is the key. Used to explain the provision and serve as a proof. Okay? You need to think of the rate rec as not this mechanical thing that like you're victim to. Think of it as a tool for you to explain the provision to other people in a concise way. Whenever I look at a new company and I try to understand what its story is, I pull up the rate rec, I find out what it has, and I kind of quickly, I mean, in this matter of seconds, you can look at a rate rec and be like, okay, this company, you know, is losing money, it has a valuation allowance. Or this company is heavily offshore and all its profits are in the Cayman Islands because it has no tax expense. Or this company has a gigantic IRS exposure. I mean, you could tell the story quickly from looking at a rate rec. Okay? But think of it as the mechanical proof plus like your storytelling mechanism. David.
When you were into this company and they couldn't support their ending balance and their liability, I don't understand that because the fact is if it's a public company, they have their it's published in their 10K. At least the history is. So you basically go from that and you put the delta to it and you come up with a conclusion. I mean, every 10K I've ever read has got all the pieces and reconciles. So what I'm really not. It doesn't. I think that doesn't make sense to me. What you said didn't make sense. If you basically had to go clean up I mean, I cleaned up a whole lot of messes in my day, but a public company has got the pieces there. I don't know. I mean, that's a statement.
Let me give you another example. So this schedule, this deferred roll forward, that same company, they had an item in their deferreds called foreign tax credit, and it was a negative number. So explain to me how you could have a credit in your deferreds for foreign tax credits, right? It can't be, right? It's wrong. But the problem with a schedule like this, and it's even called this, it's on the tab, it's a roll forward, right? You take a beginning balance, you roll forward. You take that ending balance and you make it next year's beginning balance. You roll forward. And if something goes wrong and you just keep rolling it forward, pretty soon you're like, I don't even know what that is anymore, right? That's what happens as a practical matter. And when you just get a lot of volume, things happen more, right? So when you're just dealing with 5 variables, like in our example, it's kind of hard for things to go completely askew, but when you have lots of numbers moving every which way, it's just easier for things to blow up. I mean, that's what happens. It's not things that are technically difficult, it's just process.
So, quick question. So when you make an error in a prior year for taxes, does some of them automatically reverse or correct itself?
So Timmy's question was, when you make an error, do some of them reverse? Yeah, some do, some don't. Just depends what it is. Yeah. So if you claimed an R&D credit and you added an extra 0 to the end, that's not going to reverse, right? If you claim too much depreciation, well, that'll flip back next year. Okay, so rate rec. Use it as your mechanical proof. Use it as your storyteller. Okay, those are the keys. Amanda. If Jessie was your financial auditor, she would detect the errors in your provision, yes. There would be hell to pay.
For a loss, it'll do it.
Yeah. That's why you're nice to Jessie. Okay, so in your rate rec, one question you might ask is, sometimes companies have very small rate recs, like they only have like 4 lines. Other times they have big rate recs, like they have 10 lines. You might ask, well, why 4? Why 10? Why not 6? Why not 100? And the answer is that you disclose the amounts that are significant. And that's significant. This is an SEC threshold, this 5% of the expected income tax expense. And so if you have $1 million of income, you'd expect a $350,000 provision. Or in this example, if you had $1,000 of income, you'd expect $350. So 5% of $350 is $17,500. So if you have something that has a tax effect of more than $17,500, you show it on a separate line. That's the rule. So if you're Microsoft and this number is gigantic, right, you're not going to have a lot of items that pass that threshold. You know, if you're like Cadence, remember they had a small PBT, they could have a lot of items exceed that threshold. It's just math. Okay? So it's great working for a big company that makes a ton of money or loses a ton of money, because that mellows out the volume of items on your rate rack. Okay?
How auditing these things happen. It's been a while since I worked for one. I don't remember if it was the audit group or the tax group that actually audited the tax provision and assets and liabilities. Do they bring a separate group in around that, or tax group usually, or do tax like the audit?
Good question. So Grant's question is, who audits the tax provision? Is it tax people or the auditors?
Yeah, that level of CPA.
Yeah, so it depends, right? I mean, I don't want you to think that like every company is the size of like an Intuitive Surgical or an Intuit or whatever, but with those size companies, the tax people will always be the ones that are doing the analysis, just because it's so complex that the auditors just tend not to know tax provisions well enough. If
Startup or something.
yeah, small startup. I mean, tax provisions have become so relevant to the financial statements because of the increased pressure by SOX that more people understand provisions now than ever. And I would say, like, our audit partners, by no means could I give them like the take-home exam and they come back and get it right, but presented with a rate rec and presented with like the story, they can process it pretty well, and they can sniff out what makes sense and what doesn't make sense.
And the other thing is that when you do approving of the financial statements, like usually the audit guy doing that, right?
The auditors do a lot of like the tie-outs, right? The tax guys will do most of the issue spotting and the logic. But if you went to the firm, like the big firms, the tax people would be the ones that are more expert in how to do a provision. Yeah, but the provision guys, or the audit guys, get involved for sure. Okay. All right, so that's effective tax rate. There's a super simple example. I'm going to skip right over it because it's super simple. Okay, now we're going to do, it's 820, so we're going to do the year 2 provision. Okay, so this is the hardest part in the class so far. Are you ready for that? Okay, so the first thing, when you look at the problem, let me find the problem. Okay, so the first thing you got to do when you're looking at the problem, you see we have the facts for year number 1, right? We just went through that. Okay, and then there's this whole thing at the bottom of the page where I say continued. I know it says class 5. We'll fix that. Okay, so then it says, whoops. Okay, so these are my original facts. Like, I thought I had 10 million to PBT, 20 million penalties, whatnot. And then I say, oh no, I actually filed my tax return and it was based on these numbers. So like my federal credit's a little different. My state credit's different. My apportionment's different. Everything's a little different, right? And that's what happens, right? You do your provision, and you do it fast, and you do it in January, and you don't have much time, and you do your best, but it's not right. And then you get like 8 months to do your tax return, and you get to like sit back and try to think things through more comprehensively, and you come up with different answers. So the first thing you got to do is do your return to provision. Okay? You got to compare what did I do on my provision before And how would I compare that to what I did on my return now? And what is the journal entry that comes out from that? Okay? What did I do before? What did I have now? What's the difference that came out from that? Lena, your face is priceless.
You adjust.
You adjust, right?
Yeah.
So let me give you a simple example, okay? The volume is what will kill you here. It's not the complexity of the topic. So if I thought I had a $47,000 credit on my provision, but I only had a $46,000 credit, my payable was too low. I'm going to owe another $1,000 of tax. So I need to credit my payable to reflect that I owe it, $1,000. There's no impact to deferreds, so I need to debit my expense $1,000. Right? That's how the true-up works. You just got to do it for every line. Now, where it becomes kind of a pain in the butt is apportionment. Well, I thought my blended state rate was 8.5, but now it's like 7. I totally jacked it, all right? Well, gosh, I guess that means my payables messed up, my deferreds are messed up, everything's messed up. But I need to reset my payable based on the right state rate. I need to reset my deferreds based on the right state rate, and out will come a provision effect. So if you fix your balance sheet, the provision will fall out. Okay, so fix your balance sheet. Okay, so I'm going to give you like 10 minutes to either do the problem or just take a break and like just clear your mind, and then I will show you how I would do it. Okay, I'm not going to let you struggle with this one for too long.
You get the first one wrong.
Hey, so that, I mean, there's a lot of truth to that because, so David was saying if you get the first one wrong, getting year 2 right's hard, and that is absolutely the truth, right? And when you take the exam, you will appreciate that comment. Okay, so so we did the year 1 provision, and now I'm going to kind of make it easier on you and show you how I did it for year 2, okay? But I want you to try to follow along as best as you can because you're going to have to do year 2 eventually, okay?
Yeah, on the exam.
Right. So the first thing that I do is I do a return to provision analysis, okay? And I do it once for state and once for federal. And this is actually the first time I did the problem this way. So on Saturday when I was in the office recording stuff for you guys, I also just did this problem. So I think I was telling some of you beforehand, actually I had trouble making the rate rec work. And I didn't capture that on video so you could see me sitting there like scratching my head and figuring out what I missed. But you know, I want you to know that when you miss stuff and I make it look easy when I do it here, I struggle too sometimes. You know, you just miss like one little fact or you flip a sign or something like that and the whole thing kind of goes nuts. And you just got to like rewind and go back. Right? So don't be surprised if you get to the end and something's messed up and you have to go a long ways back. Right? One of the things I did is I just didn't tax affect something that needed to be tax affected, so I was working with gross numbers instead of tax numbers. Something totally stupid. Right? But expect that will happen to you, right? That you'll get to the end, it won't work, and you have to go backwards. Okay? I will send you this spreadsheet, and you will have the year 1 solution in Excel and the year 2 solution in Excel, and you can do whatever you would like with them. The RTP means return to provision. So this is me comparing my return to my provision. Okay, so RTP is like general terminology or lingo for how to true up your provision. Okay? Alright, so I would compare, well, what did I do on my provision? And I took this column straight from my year 1 provision file, and I would put next to it what actually happened to my return. Okay? And outcome differences. Okay? So I had a difference in my meals and entertainment add back where the add back on my return was actually less than it was on my provision, right? So after time passed and I was able to think this one through, it turned out my add back was not as big as I thought it originally was. And on my depreciation, the opposite was true. I thought I was going to have tax depreciation that exceeded books by 300, but it turned out to only be 200. So here's kind of one of the zingers. I mentioned this earlier. I thought my state rate was going to be 8.5, but when I filed on my returns, it turned out to be 7.3. Right? And that's messy, but that happens. I mean, that's reality. I mean, that's kind of a significant change, but rates change. And I thought I was going to have a $42,000 credit, but I only had 40. So that's 4 differences, right? Which is just enough that when you look at the bottom, you're like, wow, there's a $100,000 difference, which looks pretty material compared to where I started, right? There's a lot of numbers moving around there. But if somebody said, oh, well, why were you different by $111,000? You'd have to start explaining, well, it was this thing, and it was this other thing, and then these state rates, and then this credit, and it starts to sound like a lot of stuff was moving around, right? And that's what happens, right? Especially in states, because provisions for states will almost always be a guess. And then, you could be a big company, file, 100 state returns, and when you add it all up, it'll just look different than your provision, right? That's just what happens. So now I got to figure out how to book a journal entry to deal with my differences, right? Because at the end of last year, I was accruing a payable in my deferreds based on that column. But that didn't end up being right. So I got to go and fix my payable and fix my deferreds based on this new column, right? Oh, now you guys are going to get like my email. Okay. So the way I did it, and you can do this multiple ways, but the way I like to do it is I like to go back to this accounts tab, and this beginning balance, that is my ending balance from year 1. Okay? So if nothing else is true, whatever you ended with last year, that is what you begin with next year. Okay? So I start with the balances that I had last year, and then I think, well, gosh, I filed my return, so let me book all my return to provision entries, and let me fix last year in that section so I can explain what last year should have looked like at the end of the year before I move on and do my year 2 provision. Okay, this is a key concept to trying to keep your mind organized around how to do this. So take payable, for example. I said I was overpaid on the federal return by $494. I got a refund of $420. And after that refund, I didn't owe the IRS anything, and they didn't owe me anything. So I would expect my balance to be 0. So I want to come up with journal entries that can explain if I started with that receivable and I trued it up and I got a refund, that I'm done. I've cleared my account.
You mean payable, right?
Payable. I don't know what I said, but yeah, payable. And the same thing is true from like the deferreds. I thought my balance at the beginning of the year was 81. I've done my true-ups, and I would expect that if I went back and did my deferred schedule again with all the right numbers, that my deferred schedule would show 50 of credits. So before I even go on to year 2, I've fixed year 1. Okay? This will not be how you actually book your journal entries, because by the time you finish year 1 and you do your return, months have passed and you'll have booked other entries. But imagine that this schedule is like your own hypothetical world where you could first take your ending balances from last year and fix them, and then pause for a second, and then go on to next year and do next year's provision. Okay, so break up the activity of year 2 into 2 steps. Fix last year, and then separately do the year 2 provision. Okay? I see people get this stuff confused all the time. They think, oh, well, the first thing that happened in January was I started accruing my second year's provision. So I debit expense, I credit payable, and then they get the second year's provision commingled with fixing the first year, and it's just a mess.
But I'm doing this in September, right?
You're doing this in September, but you're doing this Excel spreadsheet. I mean, I guess the way I would think about it is, regardless of when you're doing it, you could be doing it in January the following year, right? You know, as you're doing your year 2 provision. Pretend that like you could go in on January, 2nd of year 2, even though you hadn't finished your return. Like imagine if you just knew all the right answers all of a sudden. What would you go and do to fix that top row, right? What entries would you book? But at the end, if there was no year 2, like let's say at year 1 the world ended, right? You would expect that the receivable you owed after it was trued up and you got your refund, you're done. You have no more balance, right? And you can clear your state balance. So I should have left like a lot of spaces in here because I want you to think like you can fix year 1 and do it the way you would do it as if you had like full control over how to record these entries. Don't worry about how the GL booked them. Think about it as if you could do this yourself. Fix year 1 and then prove the balances that are in your accounts after filing your year 1 return. And if it helps you, I mean, think like, well, what if there was no year 2? Like, what if just time stood still, right? But I still needed to fix my year 1 balances. Fix your year 1 balances first and book journal entries for your return to accrual adjustments. And then once you're completely happy, you're like, I fixed year 1, it's perfect. If there never was such a year 2, I would be cool. Once you've done that, then you can move on to year 2.
Okay, but like I am in Q1 and I'm doing this. It's just a better guess, right? Or should I not touch it?
Don't touch it until you got it right.
Okay.
Grant.
On something like this, you say you got multiple years, previous years, you're still dealing with payable stuff that just got messed up. Would you kind of keep it all in one year, or would you try to keep the previous years until they clear out on the payable?
Yeah, this happens in like Europe all the time, where companies are like, I haven't filed in Germany in like 3 years, and you're like, that's great.
I haven't what?
I haven't filed a tax return in Germany for 3 years. Like you hear these stories in Europe all the time. It never happens in Asia, but always in Europe. And if you're trying to prove an account balance, it's very hard, right? Because you can prove it to a return or something real, but if you're way behind in filing, that gets really difficult, for sure. I mean, the key is to just keep it, that proof of the payable concept that I talked about, that proof just needs to be that much better because it's going to be proving many things. That's the challenge. Okay, but conceptually, I want you to be thinking like I ended last year with a balance, now I got to fix it, and I'm going to fix it by booking balanced journal entries, and I'm going to prove the right balance at the end of year 1 before I worry about there being a year 2. Okay? This concept along with that Fed effective state thing, these are the 2 most confusing concepts in tonight's class. So let's just go line by line here. So I start with my beginning balance, which is last year's ending balance. And now I'm going to do state first, and I'm going to book my return to provision for current. So my current payable went down by $111,000. Okay? So Fung, if my payable went down by $111,000, what is the journal entry I would book to fix my balances from last year? Would you, let's use debit and credit. Debit.
One of those.
Yeah, you're doing great. Just say it all together at the same time.
Debit payable.
You would debit the payable, and so what would you credit? You credit expense, right? So we go to our account tab. So that row says I'm going to debit my payable because that state payable I thought I had was too high, and I'm going to credit expense, right? So it's like the same journal entry you would book in year 1, it's just you're doing it again now that you know better information. Okay, so from the deferred side, from the states, I have a $10,000 debit to my state deferreds. Yeah.
What the adjusting entry you just made back to the table? What's the date of that? Would it be January 1st of the new year? What did you get to?
From a dates perspective, you book entries when you know what the entries are to book. But I want you thinking of this as if dates aren't relevant. I want you to fix year one, whether you're doing this in like May, October, 3 years from now, I don't care. I want you to think of it as I'm fixing year one as if like that's all there ever was. And then then work on year two. Okay. Some companies book that in quarter two when they're like pretty far done with the return. Some people book it in Q3 when they file the return, which is normal. Some people book it later if they are delinquent with the return. It's all over the place. Okay, so we booked our state current entry. Now we're going to book our state deferred entry. So when we looked at this schedule, there was a deferred item that changed, right? That $100,000 item, that's a temp item. So you would expect my state deferreds to be different. So if I went to my deferred roll forward tab for states, this gets a little complicated, but remember last year I had 21,000 of DTLs for state. Two things happened to change that. One is my rate is no longer 8.55, it dropped, so now it's only 7.32. So solely by changing the tax rates, I've changed my state deferred. So I need an entry that will take my 21 and make an adjustment by 3,000 because the rates went down. Right? This is telling me I owe tax in the future. Well, I'm going to owe less tax in the future if I don't have as high of a state tax rate.
Instead of just the balance, is that the beginning balance?
I just take my balance and I multiply it by the rate change, and out comes an adjustment, which is a decrease in my net DTLs. Okay? So when people say, does the state rate change affect your deferred measurement? It absolutely does. That's what that's doing. And then that 100,000 rolls through, and I thought I was going to have 300,000 of reversing taxable differences, but in fact I only have 200. So now I don't need as much of a DTL anymore, so I can reduce that 21 by DTLs I don't have, because I don't have as big of a timing difference any longer. Right? So this is me saying, look, I started the year thinking I had 21, but gosh, at the end of the year, end of year one, forget there is a year two. At the end of year one, I'm saying I only had 11,000 of state DTLs. Okay? I know this is a little confusing, but at the beginning of the year I said I'm going to have a credit on my balance sheet of 21. That was overstated because my rate was too high, so I'm going to bring it down. And it was overstated because my depreciation difference was too big, so I'm going to bring it down again for that.
Where's the, is it 3.137 there?
$3,137 is just a rate change times the gross balance of my temp items. So I need to book a journal entry for both these things. Okay? So Andy, what's that journal entry going to be? What are the debits and credits? Shukin can help you.
It's a debit.
There's a good chance there's a debit, yes.
It's a debit to the liability.
Well, let Andy answer. Andy, what do you think?
I'll let you to help him.
What do you think, Andy? You're going to debit. Don't worry about the numbers. Tell me the words. I thought I had that as a deferred tax liability, but now I have that as a deferred tax liability. So what is the journal entry I need to book? I need to reduce my deferred tax liability. So that's a debit to DTL, right? Okay, and what's the credit? Deferred tax expense, right? So I have a journal entry that says debit my state deferreds, credit my state provision. Right? I already booked all the current true up. I fixed the payable in that row. I fixed the deferreds in that row. And now I'm good, right? I got my state refund, my payable's clear, and now my ending deferreds for state at the end of year one, they're the new number. It's what I calculated on that roll forward tab. My deferreds are fixed, right? As of the end of year one. Forget there's a year two. Okay, I fixed year one. You could probably sell that Red Bull at this point, Mike. I think it's going for like $20. I gave it to Mike. Doesn't he look like the kind of guy that would enjoy a Red Bull?
Yeah, yeah.
You have like the biggest smile in class. I thought we could make it bigger, you know.
Could I know where the federal payable and the state payable beginning balance come from?
Where does the beginning balance come from? Last year's ending, right? I finished year one, I booked my entries, I thought I was money, right? I had my ending balances, I did my proofs, Jesse audited me, I totally passed, and then I had to start year two, and I had to start with the same balances I ended last year with.
I can find the deferred parts exactly from the payable sheet, but I cannot find the payable part.
You mean the beginning balance?
Yeah, for this team.
Well, if I went back to my year one spreadsheet, which I think it was this. That was my year one schedule. My federal payable was a receivable of $494, and my state was a payable of $406. So if I go to year two, it's a receivable of $494 and a payable of $406. I'm just taking last year and starting again.
What the relation with that payable tab? Because we just calculate all this federal deferred, state deferred, federal current payment, state current payment in that payable tab, right?
Well, don't get too worried about the... I mean, you can go home and play with this Excel file all you want. Worry about concepts. Okay? The key is, what concepts are we trying to push through here? And the concept I want you to understand is, I took last year's balances, and then I said, I got to fix my payable, I got to fix my deferred, and out will come provision entries. And after I fixed my payable, and I got my refunds, or I made my payments, I could explain my balance. I don't owe any state money, I don't owe state tax, and they don't owe me anything. Right? Like if you had an overpayment and you applied it to next year, this balance wouldn't be zero, it would be a debit, because you're still owed money by a government. Right? So it doesn't have to be zero, but you have to explain that balance. What is it?
Do you remember the $796,000 figure that was the federal payable?
What about it?
I'm just trying to figure out what happened.
Okay, so let's talk about federal for a second. That's Brian's question.
$299
Just hang tight. Okay, so federal. I thought last year I was owed $494,000 by the IRS. Okay. That was based on me thinking that I was going to have to pay federal tax of $3,105. Right? This is my provision column. So in reality, I had to pay more tax. I had to pay $3,179 instead of $3,105. So what I thought they owed me is probably going to go down, right? Because I'm going to owe more tax than I thought. So when I go to my accounts tab, I'm going to say, oh, I got to credit my payable because I'm going to owe more, and that's going to offset expense.
And that beginning balance of $494,
That. Where did I get that one from, Lena?
From your year ending balance.
My year one ending balance. Yep. Exactly. So all I'm doing is I'm taking my beginning balance and then I'm fixing it one balance at a time. Fix my state payable, fix my state deferred, fix my federal payable. And then when I'm done with that and I've pretended that there is no such thing as year 2, I can prove these balances. I can prove these deferreds exist at the end of year 1 after I fixed everything, because that's what my deferred schedule proves. Okay? So I would beg you to just do this before you started worrying about year 2. I know when I say do the year 2 provision, you think I got to do the year 2 provision. But fix year 1 first, and don't move on until you fixed it. Okay? And the way to know you've done it is to do this account analysis, because until your payable and deferreds make sense after you fix them, you're not done. Fix your balance sheet, and once you're comfortable, then you can move on.